Well, good morning, everybody, and thanks so much for joining us today. I'm delighted to be able to present the gold royalty story, but I thought before I got into the granularity of our story, I'd spend a little bit of time talking about the macro environment we find ourselves in, the case for gold, and how to best play gold and get maximum leverage to what's going to be, I think, an accelerating gold price over the coming months and years. And if you look at how gold has performed historically, I think the key chart to focus on over the last 50 years is where interest rates have gone. And we're at a point in the cycle where interest rates are declining deeper and deeper into negative territory on a real basis, not unlike what we saw back in the 1970s. And there are many hallmarks of the 1970s inflationary cycle that bear a striking resemblance to what we're experiencing today. Back in the early 1970s, the US dollar was decoupled from the gold standard. We came out of the credit crisis about a dozen years ago, and that effectively was a decoupling of fiat currencies from gold and from any hard assets. In fact, we've seen massive amounts of stimulus, monetary supply since that period of time. We also saw an oil embargo back in the 1970s imposed upon us by the Arab world, and today we have a self-imposed oil embargo as we don't partake in Russian energy products. And so we're seeing supply chain disruptions and an acceleration of inflation, not unlike what we saw in the 1970s, but with one key distinction. Back in the 1970s, global debt to GDP was about 100%. Today, it's 350%, so 3.5 times the debt level on a per capita basis. So while central banks back in the 1970s had the latitude to vastly increase interest rates to bring inflation into control, central banks today do not have that kind of flexibility. In fact, what we'll see, and we're already seeing it in Canada with the Bank of Canada announcing a pivot away from higher interest rates, we're going to see global central banks start to pivot away from higher interest rates before they've actually brought inflation under control. So we're at a point in the cycle where I think inflation is deeply entrenched, where real interest rates will continue to dive deeper and deeper into negative territory, and that's very constructive for gold. So if you look at how gold behaved in the last inflation cycle, it went over $800 an ounce in the early 1980s. And if you inflation adjust that to today's dollars, that's over $3,000 an ounce. So we're still at least 50% away from the cyclical high that gold experienced on a real basis back in the 1980s. This is a bull run that's just starting. And if you buy gold as an asset class and the bull scenario for gold, the question you have to ask yourself is, where are you best placed to experience optimum leverage to the gold price? And our argument is it's really in the royalty sector. Because what royalty companies provide you is with top-line exposure, you get a percentage of the revenue while completely insulating you from cost inflation. And frankly, we're all experiencing inflation in the general economy, and mining companies are not immune from that. And I think that's why it's instructive that after 30 years of building and operating mines, I've pivoted away from running those mines, building them, to actually running a royalty company and providing capital to the explorers and developers and taking a piece of the action back in the form of a royalty. Because what that royalty provides you is increases in the gold price while protecting you from capital costs and operating cost inflation that all the operators are experiencing. And that's why you've seen such a significant underperformance of the mining equities, the operators, relative to the commodity and certainly relative to royalty companies. Over the last decade, the gold price is up over 60%, but you can see the mining equities have significantly underperformed the gold price, whereas the royalty companies have provided multiples of outperformance relative to both the gold price and the mining equities, because as I said, they provide you leverage to the gold price, but also leverage to the exploration upside, because our royalties are not only in the existing reserves, but any growth in reserves that our operating partners realize through their exploration efforts, but again, protecting you from operating capital cost inflation. It's really the best of all worlds. It's like owning gold with exploration upside. And Gold Royalty Corp, over a very short period of time since our IPO less than 2 years ago, has grown our royalty portfolio more than tenfold from 18 royalties in our IPO to over 200 royalties within the best mining jurisdictions in the world. A heavy concentration of our royalty portfolios in Nevada, Quebec, and Ontario. And in assembling this royalty portfolio, we've assembled a portfolio that's delivering peer-leading growth in revenue. Last year, our first full year, fiscal year in operation, we delivered just under $6 million in revenue, but we have 60% compounded annual growth in our revenue going forward from 8 currently producing royalties, another 15 in construction, and over 200 from early stage exploration right through to mine development. And it's because of that revenue growth and the fact that we have a very small G&A footprint, we were able to introduce a dividend just 10 months after our IPO. We pay a 1.6% yield. And with that revenue growth that we're projecting over the coming years, we're in a very good position given the flat G&A profile that we have to increase that dividend exponentially over time. And that's an enviable position to be. So low political risk, significant growth from one of the largest royalty portfolios in the sector, even compared to the seniors in the sector, in the best mining jurisdictions in the world. And the reason we've been able to grow that revenue profile out so quickly and so dramatically is because of the depth of expertise within our board and management, collectively over 400 years of experience in mine building and mine operation, which is a unique value proposition. Many of our peers are run by financial engineers. We're run by people that have actually built and operated mines, which gives us key distinct advantages. One is we have a clear-eyed view of the underlying risk of what we're investing in, so we can appropriately price that risk. But also because of the depth and breadth of the experience of our board and management, we have unmitigated access to everybody in the mining industry. We can pick up the phone and talk to anybody, which has given us the advantage of accumulating that royalty portfolio very quickly on a bilateral basis. We haven't bought our royalties in competitive processes, so we've been able to pay rational prices and deliver high rates of return on the capital we've invested. We maintain a strong balance sheet, access to great liquidity. We have a $250 million shelf prospectus as well, which gives us, again, strong access to be able to grow our portfolio very quickly as opportunities present themselves through our significant access from our board and management. This is the opportunity as we see it. This is a fairly exhaustive profile of the industry in the royalty space. As you can see, they're the 3 category killers in the space: Franco-Nevada, Wheaton Precious Metals, and Royal Gold, who are trading at about $30 to $40 billion market cap, 2 to 3 times price and net asset value. What's missing in this cross-section is a mid-tier. And what we're trying to assemble through our rapid growth is to create a mid-tier company that's big enough to matter to institutional investors, but small enough to grow meaningfully, because these large cap companies, while they're blue chip and have high quality portfolios and richly deserve their premium, really have minimal access to growth because of their scale. And by achieving that mid-tier status, we will be able to attract that institutional investor, achieve a re-rate, a much higher multiple, while having the prospect of growing significantly off a relatively small base. And that's the opportunity as we see it, as we continue to assemble an enviable royalty portfolio in the Americas. This is an overview of our portfolio in numbers. In sheer numbers, 75% of our royalty portfolio is in Ontario, Quebec, and Nevada, which perennially is judged by the Fraser Institute in the top 5 jurisdictions of the world for mineral potential, low political risk, and low regulatory risk. And this increasingly fraught environment globally means that we're going to attract a premium multiple over time because of being in those not only geologic and prospective districts, but ones that observe the rule of law. But not only do we have sheer numbers in those jurisdictions, 75% of the underlying value of our business is also in those 3 key jurisdictions. And that drives that revenue growth. As I said, we have 8 royalties in production. We have another 15 in construction. And you can see that our revenue is growing from about $6 million to about $60 million by the end of this decade, 60% compounded annual growth on an annual basis, with our G&A costs at only $5 million and 8 full-time employees. We could run a business 10 times the size with the same complement of employees, which means every incremental dollar of revenue goes right to the bottom line and increases the prospect of our being able to grow that dividend, that 1.6% yield over the course of the next decade. And it's not just a question of the scale and the size of our portfolio. We also have some chunky foundational assets in the portfolio. We have a royalty in Canada's biggest producing gold mine, Canadian Malartic. We have a royalty on what will be Canada's second biggest producing gold mine, Côté, when it comes into operation next year. And we have a royalty in the underground extension of Goldstrike, the biggest producing gold mine in the United States. So we have 3 generational foundational assets with multi-decades of reserve ahead of it. So it's not only a quantity proposition, it's a quality one as well. Thank you very much for your attention this morning.